Two of the hottest trends in ETFs are cooling off a bit. Buying protection against the downturn in the market was the hottest trend of 2022 and into 2023. Investors owned stocks, but also sold calls that would collect income and provide a cushion against any downturn. But the market's been rising this year, so these strategies are underperforming. Another hot trend, buying the international market over the U.S. market, also underperforming. What's going on with all these strategies? Let's talk with Kim Arthur. He's the CEO of Main Management. Mike Akins is the ETF Action's founding partner. Kim, the big ETF winner last year was the JP Morgan Equity Premium ETF. That's JEPI, J-E-P-I. $27 billion in assets right now, and you've got one of the competitors, the Main Buy Right ETF, BUYW. They do similar things. They own stocks and sell calls against them, but both are underperforming this year. So when you're selling calls, you're betting the market's going to remain range-bound or lower. So, what's going on here? Why are we underperforming, and why are people continuing to pour money into these strategies?
Yeah, Bob, you nailed it. It's when you're selling calls, you're capping your upside. So obviously that works. The trade-off is to get an extra stream of income to protect you in a down tape like 2022, or in a flat tape. It works very well. But when you have an up 16% first half of the year, these types of strategies are going to underperform. I'm a big proponent, though, Bob. You want to set the expectation for each product or strategy that a client gets and then deliver on that. So if you set the messaging right, that 2 out of 3 that they'll do well, then you can kind of get through the difficult periods. But if you've told people that, hey, these things do well in all market environments, that's not the case. And the other thing that's happening now is, as the VIX has collapsed, you now have much smaller premiums that you are bringing in. So some of these strategies that tried to have double-digit type of distributions, those are unsustainable. You need to have something that is a level that you can do repeatably in all environments.
Mike, what is your take on buying protection, this kind of strategy? You noted to me that in a bull market, it's questionable if the juice you're getting from selling the calls is worth the squeeze. Explain that. It makes a lot of sense to me, actually.
Yeah. So, I think at the end of the day, you have a situation with these strategies where they're designed to provide a little less volatility and more income. So a specific set of investor that's looking for a particular outcome, these tools work really well. Oftentimes, however, especially after you come out of a bear market, albeit a short one that we just had, they start getting sold more as alpha tools or tools that can generate alpha, and that's just not the case. In almost all full market cycles, these types of strategies are going to have a much lower up capture ratio, and oftentimes a similar downside capture ratio. So over long time frames, for example, a standard call writing strategy on the S&P 500 would have an up capture of, say, 60%, and a down capture of 70%. That's great if you're looking for a specific, you understand those expectations, but in a bull market, you're going to fall. And as we know, the markets over time go up. So you are not going to keep up with the market with these types of strategies.
And the important thing is you're getting a premium here, of course, Kim. It's just not compensating you for the fact that the market's going up at the same time. So you're underperforming, essentially. That's what's going on. I just want to make sure our viewers understand what happens with these things.
Yeah, exactly. And another thing, Bob, I like to say that these have a place in people's portfolios, but it's a kind of glue between the wall, which is fixed income, investment grade. You're supposed to have downside protection. Last year it didn't happen. And they're supposed to live between that and the wallpaper, which is risk on equities. And if you look over an extended period of time, they do deliver in that bucket. It should be 6% type of returns, not equity returns, but better than fixed income.